And the difficulty with DeFi is that, the effective duration of DeFi has always been 12 seconds or the length of a block. And this is also why this is part of the reason why when you have arbitrary lengths of duration in fixed rate protocols, the liquidity completely dries up in that period, especially when there's an absence of other lenders or other users of that fixed rate at that particular maturity point in time. So yeah, leaning on the Curator to essentially make that market a bit more liquid is a valuable service.
Quick shout out to today's sponsor, Katana. We'll hear more about Katana and their pre-deposit campaign later today. But for now, let's get into the episode. Hey everyone, quick disclaimer before we get into today's episode. Nothing said on Bell Curve is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely our opinions, not financial advice. Our guests and I may hold positions in the companies, funds, or projects discussed. All right, everyone, welcome back to another episode of Bell Curve. Today, I'm joined by my trusty co-host, Monet, and today we're speaking to Tarun of Gauntlet and Adrian of Steakhouse. Guys, welcome.
Hi.
Hey, glad to be here.
Hey. Okay, guys, so this episode is going to be really fun. We spoke to Paul Frambo of Morpho on their V2, and we spoke mostly about borrow lend, stablecoin trends, vertical integration, that type of stuff. And we touched on risk curation as a genre, but we thought it might be fun to go one layer deeper even than we did on the Morpho V2 episode and speak to the two largest risk curators on the market. And Monet also is involved with BA Labs. So I'm the only non-risk curator here, so I'll mostly be staying out of everyone's way. But we've got a lot of ground to cover. And maybe just to start off, Adrian, if I could kick it over to you first, can you just give us an understanding of, just define the basic role of a risk curator here and how this market has, kind of started from basically nothing a couple of years ago to being a relatively large market today?
Yeah, definitely. I think Morpho is definitely the instigator of this change. I mean, there's always been an element of user-driven behavior in protocols like Uniswap where anybody could sort of create their own pools for any token. But I think Morpho was really the first to have this clearly defined and nomenclature and role of a curator that I feel is kind of two things. One of them is modularization. So this fits very well with sort of Morpho's philosophy of having the smallest possible financial primitive that you can build. And then when you stack those on top of each other, you can create more complexity and allow people to sort of build on top of it. And the second is outsourcing the role of the risk and, putting that in a silo and allowing people to make decisions on risk without necessarily impacting, for example, other markets or other curator activities. It comes with trade-offs, obviously, but I would say this new cohort of borrow-lend protocols is probably making the bet that you can scale much faster under this curator model than by running a sort of monolithic approach.
Mm. And Tarun, I'd love to get your take on this as well, and maybe if you could give a little bit of an overview about how Gauntlet got into this, because I think most people, myself included, until relatively recently, have thought of Gauntlet mostly as kind of an advisory or consulting sort of group. And recently, from my understanding, it seems like risk curation is a larger and larger part of the business. So could you just kind of give us, the evolution from the business standpoint and then anything to build on what Adrian said in terms of the development of the market?
Yeah, for sure. I mean, so we started in 2018. At the time, I think the word DeFi didn't totally exist. Like Dharma and Compound V1, which doesn't really exist, RIP, were kind of the first. I mean, Maker was obviously really the first, but then those fast follow DeFi protocols were sort of Dharma and Compound at that time. And, there wasn't much DEX liquidity. There's no Uniswap. And so, we started actually in terms of like trying to optimize proof of stake protocols, like how should they think about issuance. Actually, ironically, a lot of the stuff that people talk about now was sort of some of our earliest research papers and writings and actually consulting with different POS protocols at that time was actually around like how do you choose issuance, how do you adjust issuance in order to maximize throughput, how do you do it in a way that doesn't just like centralize the validator set, right? Like subject to those constraints. And in those early days of what I'd say were proto DeFi, it became kind of clear that proof of stake networks will, despite the 2017 promises of like they'll have governance and fast updates and whatever. That never really transpired for a bunch of systemic reasons, right? Like a lot of the big asset holders don't want to be actively participating. ... And DeFi was sort of the first place where you saw a more active role of members of the community in like designing the system. And so when we started, we you know, that's sort of how we kind of got into this. You know, it was, realistically, there were, you know, I'd say the entire DAO consulting advisory type of stuff started from like probably like 10 people in Discord who Monet and I are in group chats from that era in kind of just like talking about how you should model different things, what the risks are, etc. You know, obviously that evolved. I think, you know, Compound kind of opened the spigot. You know, I think Maker obviously had a particular structure, but then once Compound made it easy to copy governance, you saw this kind of Cambrian explosion. So we've been doing that for a while, and I think we, you know, written a lot of research papers on trying to formalize DeFi models, formalize the risk, and then also, you know, have the numerical evaluations and kind of stress tests. And I think in late 2021, we started to think a little bit about some of the adverse selection, moral hazard type of stuff. And we, you know, at the time we were working with Aave and Compound, and we kind of tried to point out to Aave certain like moral hazard issues with how their insurance fund worked. And it was at that time it was very clear that, you know, the DAO model has this very weird incentive where any kind of action you have to vote on that maybe has a short-term negative price impact, but in the long term makes the system safer, was like very hard to convince this group of people of. It was a little bit like proof of stake, where it's like really hard to convince proof of stake asset holders to like change issuance. You know, we saw this with Solana, we see with Ethereum, like Ethereum still hasn't even really fully made that change or attempted. And I think in the DAO model, you have a very similar thing where you kind of have this like weird incentive model where like the people who own the token might be willing to force either more insecure parameters on the users, or like kind of not want their token to be the actual backstop insurance if like something goes wrong. And I think, you know, since there have been many cases like that, but I think our experience with that in general, amongst other things, which are all kind of, you know, documented, so if you care, you can read all the forums from 2021 to 2023, kind of made us excited to try some new systems and new models. In particular, because I think we had written a lot about different types of models of like, how, you know, most DeFi systems in what I'd call DeFi 1.0 of, you know, like Maker, Compound, Uniswap, generally were like tripartite agreements between 3 to 4 types of participants. There's like a liquidity provider or a lender, there's a borrower or a swapper, there's an arbitrageur or a liquidator, and then, you know, maybe there's like an oracle provider, right? Like those are kind of the 4 principal agents you really need to think of in all these systems. And one natural question was like, if you had a 5th agent who was able to coordinate them more efficiently, would you do a lot better? Would you be able to make it more efficient? Would you be able to make the utilization and the protocol better, improve capital efficiency, right? Like you can kind of think of Uniswap v3 as sort of doing that, because you split liquidity providers into active and passive, and you were able to improve capital efficiency. And so it started to become clear that if you want capital efficient DeFi, you kind of had to go to this model where there was another type of agent who is, you know, being kind of very active in allocating. And that's sort of the philosophical reasons we got into it, sort of, and then the path into that. But then, you know, I think once we started doing it, it made a lot of sense. So yeah, sorry, I know that was a little long answer, but.
No, it's always good to get deep into it.
This episode is sponsored by Katana. If your assets are sitting idly, they're dead. Katana is built from the ground up to bring your bags back to life. Be early to Katana by joining the pre-deposit campaign before mainnet opens at the end of this month. Follow the link in today's show notes to get started. Today's episode is brought to you by Ledger, the global leader in digital asset security. Celebrating 10 years of innovation, Ledger is trusted by 7 million users, secures 20% of the world's digital assets, and remains the most secure hardware wallet for your crypto and logins. Follow the link in this episode's show notes to grab your Ledger today. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
I'm kind of curious. So you mentioned that there was like a bit of like I'm sure you guys have both seen this because you both have done, sort of curation, but also some more like advisory engagements as a risk provider. You mentioned that there's like some conflict sometimes between trying to reduce risk, but then because it has, price impacts, maybe the DAO is resistant. Um, but I've also seen interesting sort of incentive gradients as a curator as well. Like if you take more risks and you have higher yielding vault, maybe you can capture more fees. So like your sort of revenue position as a curator is better. So yeah, I'd be curious for either of you if you have like a view of how does the incentive structure as a risk provider change based on this, kind of this business model aspect.
We definitely took a like I echo the adverse selection issue. Like our history at Steakhouse is in Maker. It's in like the DeFi 1.0, so to speak. And there, the sort of old core unit model is one where maybe the fact that Maker operated as a DAO worked to its benefit from a risk perspective, because it meant that basically decisions were much harder to make and enforce. And in particular, when you have a group of core units that are advising a DAO, the more difficult things are to change, the safer, like the less reactive the DAO is to market conditions, but also on the long run, the safer the system just out of a virtue of lack of change. And I think that there's an interesting element in the Morpho curation system. We've kind of taken part of that philosophy into how we're designing the Morpho vaults, because there's definitely a trade-off but on the other hand, those trade-offs are more easily segmented. So with Maker, you kind of buy wholesale the risk of Maker when you use the stablecoin or when you open a CDP position, and you're exposed to the full spectrum of path-dependent decisions that people have made as a community. Whereas with a more fragmented curator ecosystem, the user is able to also define their risk appetite and select the vaults that match those. Nonetheless, I think there's really interesting things that you can build on top of it. So in our vaults, for example, the LPs are essentially a mini DAO through the Aragon DAO construct. And this closes the loop quite neatly on that sort of principal agent tension and makes our vaults harder to change. That's our sort of company philosophy on making things more immutable and harder to move. There's definitely an incentive. There's an element of, it's funny because in crypto, there's an element of risk premium that consistently gets underpriced. I feel like participants in DeFi nowadays generally underprice the level of risk that they take with different collateral assets. And so there's maybe not enough maturity around sensitivity to the different types of collaterals or different types of vaults. But there's definitely an opportunity for curators, for example, to differentiate along those vectors. And you see that with, sort of blue chip vaults like the Gauntlet Prime or the Steakhouse USDC versus other more edge vaults or ecosystem vaults that are catered to a specific use case and to a specific risk profile.
Yeah, I mean, I think I more or less agree with that like specialization will come from how you tranche risk. I think that sort of inherently is sometimes the problem in the DAO model, in that it's really hard to get DAO members to accept the tranches, because some DAO members are benefiting potentially from the highest risk assets because it's like, hey, maybe they're the largest holder and they're getting the highest pro rata share of fees, or they're a participant in that market and the DAO is effectively subsidizing them by giving kind of like a cheaper loan for that type of asset than like the true value should be. And I think fundamentally having basically people be able to compete to try to offer different types of verticals and specializations over time should converge to something that does a lot better. And I like there's a sort of empirical sense in which you can kind of see this if you look at sort of morpho yields across time versus Aave or compound yields. Like the utilizations will generally be much closer to the kink level or to the target level than they are in kind of pooled protocols. And I think you've seen the pooled protocols add isolated modes to emulate kind of some of the successes I think you've seen in the vault model. I think one other important question you ask is about sort of like, hey, is there kind of like this like system-wide principal agent problem? I think the nice thing about the vault model, at least for Morpho, and then we can talk about other vault models like in perpetuals or in restaking, where they kind of have a different, I would say you have to think of them quite differently. In the Morpho case, the really interesting thing, in my opinion, versus the Aave or compound original pooled model is you segment the borrower and supplier sides, where the supplier sides are sort of managed by the curators and the borrowers are just managing their own positions, but they're pooled. And this kind of matching problem is sort of almost like a one-to-many matching problem, in the sense that like a single pool of borrowers is matched to many suppliers, and that type of matching can be done relatively efficiently. And I think you talk about Morpho v2, that like kind of breaks that and you go back to this one-to-one kind of matching mixed in. In general, historically, DeFi protocols that have worked have always had some form of passive liquidity provision. Any protocol you could think of that works that has worked in the sense of like survived for a long time, hasn't been exploited, has real users, has generally not been pure RFQ. So like Uniswap X, yes, there's an RFQ element of people doing the intent solving, but there's still quite a few trades that basically go to the main chain and don't get fulfilled by the market makers effectively. I think like the pure RFQ intent type of things that require lots of interactions just don't generally work on chain. And I think what you're doing with curator competition at different levels of risk is effectively building in that kind of like auction mechanism for each transaction, which you don't really have in kind of the original DeFi protocols in a DAO.
Well, Tarun, hold on. Can I ask a question about that? So the criticism of that RFQ mechanism, like having the RFQ layer and then the on-chain more passive layer, is that should be bad from a markout or lever perspective for the on-chain portion, right? Because the market makers, the professional market makers who participate in the RFQ just get to pick off all the trades with the juiciest spreads, and then they kick the scraps on-chain. So I don't know if that...
So the thing is, RFQ models have this pure RFQ models have this one fatal flaw, which is they lose liveness. Like if there's a really big market shock, like all the market makers will stop quoting. And the average user who exactly at those times is like, wow, I want to get out of all these positions, they will never come back to your protocol if like they tried to hit swap and it basically never was fulfilled at all. So you do need that backstop, and usually at those times, that's when you do actually see LPs make non-trivial percentages of their profit. But yeah, there's definitely this trade-off of having the hybrid models. But I would argue that the vaults right now are sort of a kind in lending. It's a little bit different because when you talk about a markout in a AMM, you're sort of talking about many trades in some time horizon, and you don't know the number of trades. Whereas when you're talking about the loss inured in a liquidation, it's sort of a fixed size and duration, and you can actually exactly measure your loss, right? So for lending, it's actually a lot cleaner to have this separation. And I do think there's less adverse selection provided there's some amount of competition, because basically you could think of the curators as every time a new loan enters, like one abstraction of it is every time a new loan enters, they are bidding with their liquidity of how much they're allocating for that loan, right? For the rights to the fees of that loan. But they don't realize the fees immediately, right? They realize the fees over the duration. So they're taking risk to do that in a way that the market maker on a DEX is not really taking that much risk, right? They're taking the duration of both legs of the arbitrage. And that extra duration risk is something real that you have to be compensated for. And but it's also providing a lot of direct utility to the user because they just got a cheaper interest rate from the people bidding with their liquidity.
Well, Tarun, I'm glad, and Adrian, I would love to get your response here, but I'm glad you brought this comparison up actually in between, AM at like, market making on, or providing liquidity rather, on Uniswap versus Curator on Morpho, because they seem actually somewhat related to me, in a sense, right? There's the connection here being it looks something like on a form of on-chain market making. Obviously, providing passive liquidity on like a Uniswap AMM is basically exactly that. And then in Morpho, it's a little bit, you have to squint at it a little bit more, but I'm sure there's quite a bit of control that the curators have over, these are the assets that will allow within our vault. There sometimes have to be gaps bridged, so you have to inject liquidity. Maybe it's not quite the same thing, but you kind of squint at it and it seems like a similar activity. Is that roughly correct? Or talk to me about that comparison.
I agree, right? But there's definitely like Tarun said, they are different to a degree, and the curator is, yes, sort of bidding for, like, the curator has to balance between bidding for fees or interest rates and being able to secure, well, the number of variables that's open to a curator is, I would say, there's more dimensions across which curators can optimize for their lenders relative to an AMM. And fees is just one component of it. But for example, if you consider hitting the utilization rate and not incurring the risk of a liquidity trap, for example, as being a factor or a variable, there are some trade-offs between generating enough lending return for the vault users versus vault users being able to withdraw. And so it becomes a little bit more complicated. I think in time, it's more, at an atomic level, the borrow lend market looks a lot like an AMM if you had curators allocating to individual markets, let's say. But the moment that you start pooling, I think a lot more optionality opens up. And here curators will have different objectives. You'll have curators that try to max yield and they rip the face off the borrowers by reallocating aggressively. And then you have other curators that are a bit more prudent and try to equalize the rates in a more balanced way.
By the way, the auction analogy I make is not a random or casual one. A few months ago, I tried to actually write out. So there's kind of these kind of classic results in auction theory. That's like, how many bidders do you need for an auction to be mostly competitive? Like, not you get 90% of the maximum revenue or 90% of the welfare. And it's like the number you get for a lot of cases is like under 6. Like, you don't need like a ton of bidders in order for it to be super competitive. And yeah, I wrote this paper on like, hey, for these curator models, how many curators do you need to get to the point where you are, very close to the optimal utilization or target utilization? And it's not that many. So in some sense, there is a version of the world where, there's a lot more dimensions to take into account, but also by just having a little bit of competition, you're already going to be like significantly better than the static pooled model. And I think that, if there is this question of like, hey, how much of a trade-off, in AMMs, that's not so obvious. And in fact, in a lot of cases, that's not true, where just because you have more bidders doesn't actually necessarily mean that, you get that much better prices. And like there've been a bunch of recent academic papers comparing CowSwap and Uniswap X, kind of showing this type of thing where like the improvement for the user isn't that much relative to the losses to the LPs. But in the lending market, you can show it's actually much cleaner in some ways. So,
well, you see that in the difference between like the blue chip lending markets against wrap Bitcoin or wrap stake ETH versus some of the more tail assets where fewer curators allocate. And there's more active rebalancing and more of this auction dynamic, which is interesting.
Shout out to today's sponsor, Katana. Katana is a DeFi-first chain built for deep liquidity and high yield. No empty emissions, just real yield and sequencer fees routed back to DeFi users. Incubated by Polygon Labs and GSR, Katana is launching with notable ecosystem of primitives, assets, and partners like Morpho, Chainlink, and more. Be early to Katana by joining the pre-deposit campaign before mainnet opens at the end of this month. Follow the link in today's show notes to get started. Ledger is the global leader in digital asset security, trusted by 7 million users and securing 20% of the world's digital assets. In recent years, Ledger has built a comprehensive ecosystem of products and services, making digital ownership more secure and accessible for everyone. Ledger's newest devices, Ledger Stacks and Ledger Flex, introduced the world's first secure touchscreens, making it easier and safer to manage your assets. Alongside Ledger Stacks and Ledger Flex, they have also launched the Ledger Security Key app, offering a safer alternative to traditional password management. Follow the link in today's show notes to get started with Ledger today. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
To kind of follow up on that, I'd be curious. I imagine you guys are both deep in the weeds of how you'll be setting up your strategies for Morpho V2, which was just recently like publicly announced. It's um, similar in a lot of respects, where it basically like has bought curators that are sort of selecting the sort of risks that they're addressing on behalf of depositors, but it's based on fixed rates. So um, how do you kind of see like the design space as a curator changing? And do you think that there might be like more, maybe like more similarities to market making or active like sort of PvP aspect to it?
Would I mean we 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 have like this TradFi lens of looking at things, and the Morpho V2 or the fixed rate model component of it at least looks a lot like there's a useful model in sort of on the run and off the run treasuries, where you have this sort of open market for treasuries that's going on all the time, but it's very illiquid unless it's at specific points in time when all of the bids concentrate, and that's usually at the sort of primary issuance. It'll be interesting to see how this market develops. I expect that the blue chip assets will settle very quickly into a cadence. It'll be interesting to see what that cadence is, where curators almost coordinate in an automated way to make sure that the auction markets for specific collateral assets at specific points in time are the most liquid possible. It'll get probably a lot more chaotic around longer tail assets. So it'll be interesting to see how the market responds to this dynamic and where the yield curve settles. But I think one of the points that Tarun made earlier, which I think Morpho V2 makes really interesting, is this ability to sort of switch from the lender perspective between the fixed rate vaults and the existing V1 vaults. So there's a very clean transition from the lender perspective, from having this potentially more efficient or more competitive auction market, which is a bit more discrete in terms of its structure, and defaulting down to a more continuous rolling model for the V1 markets, which will hopefully provide a better lender experience as well.
Yeah, I mean, I guess I also take a step back and think of all of the failed fixed rate protocols in the last 4 years. No, more than that. Sorry, it's 27 years. Because like actually, even when Compound V2 came out, I remember there were all these people who were like trying to make fixed rate DeFi protocols. Like probably that was around the time Aave was probably switching from ETHLend to what they are now, and there was already like kind of this huge demand of like, hey, we want to have fixed rate lending protocols. And what people realized was, hey, the only way to kind of replicate fixed rate stuff at that time was to kind of have an AMM style pool where you could trade the variable for fixed rate and somehow like do a duration transform. And I mean, I think a lot of the people working on this wouldn't have called it that, because I think most people were developers and not traders at that time. But then you had this whole line of protocols who were trying to do fixed, and I can tell you as an investor in some of them, I understand. I lost my shirt in many of these, so I understand the dynamics that occurred. But basically what happened was the AMM pools were sort of very inefficient. So compared to like the lever arbitrage loss type of thing you see in a spot AMM, the arbitrage loss in these fixed rate AMMs were really large. But an interesting thing that came out of the fixed rate AMM market, so maybe there was like $100 million invested in it in 2019.
Why was it so large? Sorry, Tarun. What was... And
The
lever, by the
why is the
way, for...
loss?
Yeah, we've also... I realize we've just been using that word. Could you just define
Yes.
what that loss
Sure.
is for the LPs, and then why is it bigger in a fixed rate versus like a unit?
Yeah.
Style?
So lever, and there's many arbitrage losses. It's not the only one, but the simplest way to think about it is like you're an LP, you put two assets into a pool, and someone makes a trade against you. Generally speaking, they're making the trade. If on average, the reason they're making the trade against the pool in the direction that is opposite to the more valuable asset, like they're arbitraging a more liquid pool, then you as the LP are taking an arbitrage loss. Like you're owning the asset that's worth less, more of the asset that's worth less, and less the asset that's worth more. Now, you can fractionalize that into components that depend on how much of the order flow is bad in that, like toxic like that versus not, and you can think of lever as quantifying the toxic versus not toxic. And the name loss versus rebalancing is because the arbitrager is rebalancing this portfolio you've given to the AMM, but they're charging you a fee for it, and their fee is larger than the benefit you're realizing. And so the reason the fixed interest protocols arbitrage loss was so high was that a lot of times you have to hold the duration risk over the fixed rate loan over whatever the duration is. And I have to look at the current on-chain interest rates, the variable rate, and say like, okay, how much am I willing to pay in basis points for holding this fixed rate loan? But if the variable on-chain rate, say a whale took a huge position out, like say there's a new yield farm and someone, spiked utilization a lot, you would suddenly be taking this gigantic loss. And so if you look at the interest rate markets, they're much more spiky, the demand. It's like less, smooth, like spot trading. And those spikes cause you like all your loss, basically. So that's I'm trying to give like the ELI 10 or 5 or whatever version of it. And the interesting thing is the most successful thing to come out of all the fixed rate interest rate protocols is actually Pendle. So Pendle, which probably has 5 billion TVL, something like that right now, 4 or 5. They started as a fixed rate protocol and just kept pivoting and iterating until they realized that, hey, we're going to offer this fixed rate type of exposure, but we're not going to do variable to fixed rate trade-offs. We're just going to take a yielding asset, split it into the yielding part and not yielding part, and offer this kind of trade. And so the interesting thing is that whole era of the early fixed rate protocols, I'd say the crowning achievement was Pendle worked. And it worked a lot, right? Like and they grinded for years. So like, I think everyone thinks of the success of the last 2 years for them, but it took them a long time to get to that. So the reason I bring up this history is this is also, I think, why people stopped being ambitious about fixed rate protocols, because they were like, everyone tried and like tons of money went into it and it didn't work out. But I think the interesting thing about Morpho v2 and Aave v4 and likely changes to Euler, I think everyone is going to kind of do this thing is by segmenting the market into the kind of pooled variable part and then kind of allowing the same liquidity to be used in both fixed and variable, you're avoiding this kind of inefficiency of needing the AMM. You're making the curator figure out sort of the ratio, the price, versus like having a fixed AMM that like has tons of MEV that is static and everyone can see how to trade against it. And I think that will be, hopefully this will prove out that like you can do fixed rate, but you kind of need to have this more active management to get to work.
So, okay, let me see if I can just repeat that back to you. So basically the loss and the reason why this hasn't worked in the past is, maybe another way of saying this as well is that, yeah, if you are a lender, you're taking variable rate risk, which in a very cyclical, very spiky sort of environment means, you can LP at, whatever, 40% APR and then it can drop to 0. That feels like a very different risk than if you lend at a fixed rate and then for whatever reason the market falls out. You could actually experience loss of capital, which is like a very different type of risk. And there was a lot of lever, which was bleeding in the early models here. Now, if you take the idea of a passive pool, which needs arbitrageurs to rebalance it and they get to extract a lot of fees, you have more active management, like a UniV3 or a hooks or something like that. Doesn't that also just mean that who's going to take that margin? Is that the curators that get that margin instead? Like, is this great for you guys? Is this a bull market for curators here, or what happens to that?
Well, it's a service, right? Similar to how curators today like allocate between different markets. Like what we're describing at the moment is the difference in liquidity between off-the-run treasuries and on-the-run treasuries, and the concentration of liquidity at different points. And the difficulty with DeFi is that, the effective duration of DeFi has always been 12 seconds, or the length of a block. And this is also why this is part of the reason why when you have arbitrary lengths of duration in fixed rate protocols, the liquidity completely dries up in that period, especially when there's an absence of other lenders or other users of that fixed rate at that particular maturity point in time. So yeah, leaning on the curator to essentially make that market a bit more liquid is a valuable service, and it's comparable to the role of a curator in a V1 model, even if there's an extension of moving beyond sort of borrow lend on site to borrow lend on an arbitrary duration basis, let's say.
I guess one other thing I would add is it's sort of like, it's like being a primary dealer in the on the run off the run analogy, right? Like you do end up having to have these people participate in the auctions for treasuries to make sure that you can deal with this kind of demand shock. And I think it's the kind of similar role as you see in traditional finance.
Okay, last question here, and then Monet, I'd love to transition into, maybe you can lead the institutional part of this conversation, but what should the introduction of V2, or basically fixed rate borrow lend across, maybe it's V2 and Morpho, but let's say Euler and Aave V4 adopt this as well. How does that impact the market of risk curators? And, I think in a lot of these intent-based protocol designs, right, that could be everything from V2 to like an across or Uniswap RFQ style construction. There's always this idea that, hey, all of these builder, solver, curators are going to pop up and pick up the free dollars that are lying on the ground, but they never fully seem to. So Tarun, this is kind of coming full circle to your question about how many different curators in this instance do you need for a market to be competitive. It's consistently surprised me how few actors there are in each of these markets. So I'm just curious if all of you, Monet, you included, have thoughts on why this market has remained relatively small. And I'm also curious, how it seems like the fixed rate borrow lens adds a dimension here of complexity. And I'm wondering how that will transform the market. Will it make it larger, more concentrated? Just curious to get everyone's thoughts.
If you want to go first, because it's 1 verse 3 and that the answer to this question.
I know. Yeah. Sorry.
I mean, at least in the V1 space, it's very competitive. There are quite a lot of curators. There's like 20 or 30 or something like this. But when you get to a space that starts to become more competitive and you see fee compression, curation still the barrier to entry is a lot lower thanks to tools like Morpho, but it still requires some degree of technical expertise and domain knowledge to succeed. So I would be surprised if the market doesn't end up concentrating around the top 5 curators, say, of at least for a specific vertical, like around the V1 vaults. But it's true. Well, that said, this is very focused on sort of Morpho specifically. If you had, for example, Aave or Euler or what have you introduced their own version of a fixed rate lending protocol, I don't expect them to integrate or be interoperable, at least in the near future. Similar to how with stablecoins, you don't see singleness of money, so you're not able to take a USDT to Circle and redeem it for $1 or for USDC and vice versa. So this kind of forces there to exist a multiplicity of stablecoins. Across different protocols, it's likely that there's going to be much more opportunity for curators to build smaller verticals. But even then, you'd have to abstract to the sort of lending market space and see which one of those is going to acquire the most volume and how that evolves over time, which will determine essentially the number of curators that are available.
I think, like, in general, a lot of markets have this structure where they don't have that many participants, or they have like kind of the curator market where it's like a small number and then a lot of long tail. For instance, like the payment for order flow market, now that the auctions are public, you don't see that many market makers applying, even though there's a lot of firms that could. There's actually very few people who bid in like the auctions for like Robinhood order flow, for instance. Um, there's a lot of reasons for that. I think one, for dexes at least, I think maybe 2 years ago I wrote this paper on like if there's sort of a congestion cost from having more people bidding at the same time. So like in the Uniswap X case, say there's a user who's like, I want to buy 1 ETH for, I'm making up a price, $1,000. And each, the bids that are being sent, it's a Dutch auction, is like, I'll sell you for 9.99. I'll sell you for 9.98. I'll sell you for 9.97.5. If, as the people are bidding closer to the true value, they're also increasing their costs externally, like, oh, all of them went to Binance to go buy the asset to fulfill with at the same time, they actually worsen the overall price that's received, because basically there's this congestion cost of all of the solvers having to go source inventory at the same time in order to deliver it. In lending, that's like not as clear where that would happen. So it might actually be that you could have more than, I think the DEX market really concentrated to like 3 very quickly, like almost instantly. And sort of this has been one reason people have suspected. I think in the lending market, it's going to be a little more like and especially in the fixed rate world, what's the differentiated borrow demand you can generate, right? Because I think at some level, yes, there is curation competing for the loan rates, but there's also just a sense in which you are likely to have very different types of borrowers than you have for V1, when you can have fixed rate, large size borrows, but like you as the curator have to be like, okay, this large size borrower comes in and wants a duration 1 month, 10% loan, but they take up 50% of my liquidity. So that means I get, I have to kind of look at, oh, well, what would, in hindsight, how much would I have regretted giving them that loan for a month versus keeping it in the V1 pool and taking the up and down interest. And so I think there's going to be a lot more of that type of stuff, which will generally mean that the type of borrower demand and quality of borrower demand will decide, I think, a lot more than in the V1 markets, how many curators can survive. But in general, if you look at lending businesses in traditional finance versus trading businesses, trading concentrates more than lending. There's a lot more special purpose lenders, tail lenders, stuff like that. And I do think like as the types of lending products grows, you might actually see the market grow. It just might not grow linearly. It probably grows sublinearly.
Well, at the margins, right? Because I see the curator role more as the wholesale lender in a traditional context, where at least for a V1 construct, potentially for a V2, there's a degree of origination cost that's borne by individual players that have like the tail.
Yeah,
And
that's
large
true.
scale, banks or balance sheets do the sort of top line senior lending, and they kind of allocate across everything. Though it's true that with the V2 model, there's an element of cutting down, especially for niche assets or tail assets. I think this is definitely going to be an interesting dynamic.
Yeah. And also I think it'll move, to some of the other things. I think there's more than just lending also that people are basically doing curation for now. So that widens the market quite a bit. Like in the perpetuals market, it's a totally different set of participants. I think we might be the only ones who are doing both right now, to be honest.
Yeah, putting my curator hat on for a moment. Yeah, I would say for the Morpho V1 markets, it's in a way it's actually been just the way the V1 markets work. Like all the curators sort of need to consolidate around a few different pools with similar parameters to make the markets liquid enough to even be usable for borrowers. So it's tougher to be differentiated, but I think that'll be an interesting development for V2 and also with some of these other, curation verticals is just that the design space is wider, so you'll be able to kind of uh, compete on product a little bit more rather than competing on uh, brand or distribution or what have you.
This episode is sponsored by Citrea. Citrea is the first zero-knowledge rollup to enhance the capabilities of Bitcoin blockspace, enabling Bitcoin applications and unlocking Bitcoin's full potential as a programmable financial platform. With Citrea, developers can now tap into Bitcoin's liquidity to build scalable payment systems, privacy solutions, and more. Citrea is currently in its testnet phase and is approaching its mainnet launch. To learn more about Citrea, follow the link in today's show notes. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
But yeah, I would say maybe this is a good point to kind of segue into talking about like sort of the institutional side of the curation business. Um, I know there's been really huge demand from institutional borrowers to access fixed rates. Um, And Tarun, you mentioned like maybe that'll be like sort of a differentiator is you're actually sort of taking on more of like an originator role rather than just allocating capital to opportunities that are already out there existing in the world. So yeah, how do you think the sort of BD side and the sales side of curation is gonna develop in an institutional context?
I guess like in general, I think the interesting thing between in these curator protocols is like the BD is sort of half shared by the uh, core protocol as well as the curator. I would say, in these early ecosystems, I think there's obviously more collaboration, and then over time things change. Although I will say, you know, running perpetuals vaults, the perpetuals market is like the people making the vaults don't like talk to the curators at all. They're just like do whatever you want, and that market, because it's so large in terms of like the amount of yield produced, there people just show up. Like I think there is way more long tail curation in perpetuals than there is in lending. Mainly because I think you're taking way more risk on behalf of the users, so you can differentiate your strategies quite a bit. Like they're not all delta neutral. I think there's actually that's actually kind of an interesting thing. Is like I don't think the data on the perpetual side is like particularly transparent yet. But as that improves, I think we'll see more of that. But I think the lending market is kind of interesting because there is this wholesale lender aspect of like you do want to be an aggregation point for borrowers and lenders, and you do want to try to find differentiated borrow opportunities. I think, I guess in this podcast we've talked a lot about how Morpho maybe was sort of the first curation protocol. I would actually slightly edit that to say Morpho is the first successful curation protocol. I think there are a lot that failed before or that were like kind of doing the same thing. Maple V1, I think like some of the older kind of people trying to do like RWA lending, RFQ style, where you had like a curator who is like an underwriter originator, and there was not really much that the smart contracts were doing. I think in those failed obviously in the case of Maple V1 it was adverse selection, but I think you are kind of what V1 and V2 are doing. V2 is really doing is like blending in that model with the existing kind of pure on-chain model. And the question is, what is the relative sizes of those? And I think that will change the sales. Like if the V2 model can actually bring more borrower demand than the V1 model can, but the V1 model brings in all the excess liquidity, then you might actually see a very different sales cycle where people are selling to the institutional borrowers more directly. But if the capacity is limited by the V1 model in some sense, the V2 capacity, then you may see kind of more deals on the supply side. So the reason I'm bringing this up is like I'm saying it's actually quite uncertain as to whether you're marketing the demand side or supply side until we see a little bit more about how the V2 market develops. I know that's like a sad nothing burger answer because I said you have to see how it goes, but I'm just saying I don't see a strategy where you're trying to do both at the same time. I think it's you either end up going all demand or all supply. And
we actually take that's interesting, and I agree that the Morpho V2 option space opens up dramatically, in particular with respect to the opportunities. But kind of taking Mike will be familiar with this, but at Steakhouse, we wear balance sheet tinted glasses. So everything is a balance sheet to us. And all balance sheets start with the liabilities, with the users. So in the Morpho context, that's the lender essentially, where if you have to effectively match a two-sided market between the cash portfolio manager, let's say, and the risk portfolio manager, the problem kind of starts at the lender. And when I originally asked something about like institutional, like for us, the institutional user or the DeFi user our thesis is that you kind of cater to everybody if you build something that's set up for institutional use later on. This meant that we had a bit of a slow start at the beginning because the way that we configured the vaults, for example, was quite conservative and boring. Longer time locks and all this. But I think these things really lean into things that will matter in an institutional context. And then again, sort of deriving from the stablecoin experience, when you think of a regular bank, for example, where you have a separation between the operational execution of a bank and of running a deposit balance sheet and of allocating those assets, and the legal enforcement of some of the claims on those assets, they're separate. And I think the big difference in a DeFi context is that those two are fundamentally combined. And I think this is ultimately the value proposition for fundamentally moving more traditional finance transactions on chain, where you can have the guarantee of enforceability and rule selection upfront. And the more that you lean into these features and these characteristics, the more attractive you make it for, quote unquote, institutions. So in other words, I think this is where, in the different trade-offs that the Morpho team aimed at or selected for when they were building the early vault and lending market, they leaned very heavily on immutability and lack of governance for certain market parameters. I think to a degree, part of this was as a way of concentrating liquidity. So for example, the LTV values are hard-coded, and that kind of prevents, infinite fragmentation across LTVs for curators to allocate to. But it's also kind of part of the value proposition also, because you can very transparently disclose what the rule set is. And the immutability around governance is, in our view, a type of embedded supervision where the more trustlessness you have in a vault, it essentially equates to, less counterparty exposure. And like these are the things that large-scale capital allocators are looking at. And they translate immediately into a benefit that an individual user will also have. So like something that works, something that's immutable and governance-less or trustless, that makes it work easier, and it's easier to explain to a TradFi user, for example. But that benefit translates immediately to the person with $1 who allocates the Morpho, because they get the same benefit. And there's an element of, because of this specialization of the vaults, again, relative to more monolithic platforms, the cost to being a minority user is lower in our view. So if you were a small staked ETH holder, for example, in Lido, the cost of a large LDO holder is larger until you have the mechanism with something like dual governance to mitigate that cost. And with Morpho, because the vaults will specialize and users will pick different vaults, even a small user is proportionally a larger share of the LP base and can therefore have an outsized impact on the curation decisions or collateral onboarding decisions. And so I think the future of this business really is institutional. I hope to see it in a place where we don't make that distinction anymore. I think there's a lot of features even in V2 where just from a loan servicing perspective, it would be really interesting to see traditional lenders start to use that infrastructure to originate stablecoin denominated loans to businesses or to individuals. I definitely get the sense that that's where the Morpho team wants this to go. In the near term, it'll probably be more around still sort of very DeFi heavy, crypto focused, speculation on yields, the emergence of a yield curve around, for example, Bitcoin or Ethereum. Like these things are definitely interesting and they're valuable in creating a capital markets on chain. But anyway, sorry, to wind up a long-winded answer. like from our perspective, all balance sheets start from the users, and that's on the liability side. And then everything else is kind of optimization around the parameters that you allocate or expose those users to. And the more immutable you make it and the more trustless you make it, the stronger value proposition it becomes for all cohorts of users, not just institutions. Afterwards, there may be requirements around KYC and things like this, which you can build in more easily into a modular protocol versus a monolithic one. And that presents certain advantages. But I think fundamentally, this is something that resonates with a traditional audience. Like people get it very quickly.
I've got a question for you guys on maybe a potential future state here. Sparked a little bit, Adrian, what you were just describing, but also Tarun, on your observation that there's a longer tail of more specialized lenders. I'm flashing back actually to a conversation that I had in like 2018 or 2019. Shout out Ali Hamed if you're listening to this. But he was describing some of the opportunities around consumer lending and leveraging unique data sets, like something like let's say TikTok wanted to create a platform or a platform where it lends to its creators, right? They have very specialized data. They have a good sense of they can underwrite. Hey,
I think I once you said that, I think I actually know this person who you did the shout out for.
Yeah, he's great. Yeah, sorry, I can't remember the name of this fund.
He was doing a lot of this like YouTube creator lending for a long time.
Yeah, but the reason I'm super interested in it is because there's a little bit of a connection in between. I've thought about this too from a Blockworks standpoint. Like I've seen a lot of backends of like new shows. I have a very good sense, right? Like just kind of looking at it, not even being particularly sophisticated. Like, is this person going to be able to make money based on what the show does in the first 6 months or something like that? It's pretty easy to do. And I would imagine you can get very, very sophisticated if you had a data set as wide and deep as something like TikTok. So today, I think we're all looking at this from the standpoint of, okay, we're, kind of slicing and dicing different loans so we can fund, leveraged looping trades or something like that. Or maybe then the next thing that we're dreaming bigger is we're going to bring community banks. But I'm wondering if there's an even bigger opportunity here for especially fintechs or something like that, or like social platforms or something like that have very unique data sets that they could leverage something like a vault or infrastructure as neutral as a vault. And I'm also curious, Tarun, Adrian, and Monet, how much of a value proposition and a sell from the institutional standpoint, and I mean institution in the sense of someone like a BlackRock or potentially someone like a TikTok, how influential is it that they have a say in controlling the infrastructure themselves as well, right? Like this is kind of the DeFi mullet question. So that was a bit of verbal spewing there, but I'm curious if you ever see a future where there are some more differentiated vault curators, and I'm sure BA Labs, Steakhouse, and Gauntlet will be right up there with the TikToks of the world. But I'm curious if you see those, if you play this out long enough, that you could eventually be competing with some of these types. Tarun, you live very far out into the future here. Adrian, sorry, yeah, whoever.
I don't know that we're going to start lending to TikTok creators immediately. But in the future, again, like projecting way out, there's no reason why, like to make it a bit more grounded, for example, think of something like a SME lending, for example, for something like trade receivables. Like this is a loan, the loan servicing and loan origination happens at the last mile, and there's a lot of specialization required and shoe leather that you need to wear out to make SME loans, basically, and underwrite them correctly. It's possible that one of these platforms may eventually become a curator and try to source capital on-chain, let's say, or use on-chain infrastructure to try and do whatever it is that they're doing. But like the data aspect, like all of what you're describing is kind of what we would consider sort of underwriting or last mile underwriting.
Yeah.
And I think the curation business segments very quickly into senior and junior, and you start to see a lot more tranching around risk, where you might have a curator that does a specialized vault for TikTok lending or SME receivables financing or whatever. But then they themselves, again, thinking back to the sort of balance sheet analogy, they need to raise, like that balance sheet has a funding cost, and that funding cost needs to be met by people lending to it. And I think curators will still have a role as sort of wholesale lenders to these types of markets. So I see it more likely a system where it coexists rather than one that's strictly competitive, because I don't think it's likely that Klarna will create a Morpho V2 market for, buy now, pay later loans and expect a lot
Why
of people
not
to.
though?
There's
Why
no
not?
reason why they should, and
That's kind of
expect
where
a
I
lot of
went.
people to
Yeah.
expect a lot of people to lend to it directly by its own right.
Yeah.
So where they may be more successful is in raising wholesale capital on chain from different sources, stable coins or more for curators, and then do that allocation themselves while paying the funding cost.
Also, I feel like maybe there's a bit of a challenge with like DeFi, it's been so sort of locked in on like variable rates that, Morpho V2 is planning to have fixed rate loans, but the liability side of it is still basically you're funding everything with demand deposits. And I think in some respects, that might cause some challenges once you get into let's say like riskier assets like a TikTok creator like term loan secured by their show or by their profile like um there's probably going to be some amount of defaults for those sort of products, and if you have demand like demand deposits funding everything, then it's always going to be like a race for the exits as soon as somebody defaults. um
Mm.
so I almost think that I don't know, maybe there's an aspect where like uh there will be some future curation protocol uh, that is set up in a way that's more suitable for that.
Mm.
Yeah, I kind of agree. If I look at like the fund structures around these like lending vehicles for things like the YouTube loans, like I guess like things Ollie set up, um, it's like they kind of have a very weird structure. They're a little more like private credit, right? Where they like allow some
Right.
amount of redemptions on some periodic timeout, but generally speaking, they're like not demand withdrawals at all. Um, on the other hand, a kind of interesting question is like how do you do syndication? And you can argue that Morpho is a very opinionated decision making process on how you should syndicate loans, where the curator is acting as the like there's a bunch of pools of loans of SPVs of loans, and which are all sort of relatively homogenous, at least to some extent. And we have this capital we want to allocate it to, and you by depositing the vault are buying the syndicate, right? You're buying those partitions of loans, and there is a question of how to make a syndication protocol that allows for mostly demand withdrawals, but also allows also has some like immutable parameters that are like, no syndicate can ever go over 10% into like non-withdrawable, right? Like stuff like that. So yeah, to Monet's point, I like you could imagine layering this on top in a modular stack. You could imagine layering this on top as a set of rules on top of existing vaults. And I do think we are starting to see a lot more of these like vault bundles. Like it, just like in normal finance, like yes, technically there are hundreds of millions of rated assets, but like realistically only like the top, point 10 basis points are traded regularly, in corporate debt and also in other loans. So if you think about the fact that like yes, there's gonna be a ton of vaults, but like only a small number are gonna have this like active demand and withdrawal, you may actually find that there is demand for these kind of like long tail things. I think the first things to get right though are like figuring out how to do these fixed rate types of things to like service that market, because that market doesn't want to pay variable interest rates historically. And then B, figuring out the Oracle issues for this type of stuff. I think the TikTok and YouTube influencer one is actually a much better loan than many RWAs from an Oracle risk standpoint, because you could imagine in a world where ZKTLS is sufficiently cheap. All of these people who are doing ZKTLS lending, like Earnify and stuff like that, they're kind of examples of this, where ZKTLS is like, I go to the website and I generate a ZK proof that like, hey, this many views of the app were found, or like, hey, this is how much my earnings were from Google. And I make a ZK proof that shows that like I logged in using my credentials and like this is the actual number. you can actually imagine that type of oracle working for a Web 2 company type of thing. So I don't think it's impossible for a sort, but there are a bunch of moving parts. Like A, figuring out syndication, B, figuring out the oracle stuff, C, figuring out how to make it so that like you can have depositors can like look like a homogeneous blob in a vault, but some of them maybe are not. So I think like there's a lot of problems to solve, but it's not impossible. If that makes sense.
I hope Rune will listen to this episode, because to the syndication point, I think his answer would be subDAOs, would be the stars in the Sky ecosystem, because they're regulated exactly as you described. Like, no, in the Atlas rules, the encyclopedia of things that a star can and can't do, and that's like one approach, which is really interesting to see how this will evolve as more stars launch in the near future. And then on the rest of it, it's funny because there are 2 points that you Monet, I think, raised. One is the demand. So all of the deposits are essentially on site, and the other is that some of these loans, yes, like in particular in like things like private credit in off-chain SPVs, the redemption windows are gated to specific days or specific times, which makes the duration impossible to match. There's an interesting parallel with V1 borrow lend markets that are stuck in a liquidity trap for what it's worth. So like as long as the utilization is at 100, the vault depositors can't withdraw. And that's a similar element, although it resolves much quicker typically than let's say a 90-day window. To me, that sounds basically like a fractional reserve stablecoin, where what will be really interesting to see is how the user behavior evolves over time for vaults. So you may have, for example, a blue chip vault where where even if the deposits are on site, the effective duration is much longer. And Maker has this exact problem, or sorry, Sky has this exact problem, because in theory, the entire balance sheet of USDS can withdraw within 12 seconds. And so the asset liability matching is an extremely complicated problem to solve if you want to rule yourself by the purely on-chain constraints. But if you take a more behavioral view of how users interact with the vault and you measure the gross and net outflows, you can start to create a track record and a tape of, let's call it effective duration of the deposit side, which can then allow you to take more educated guesses as to what exposure you can take on the asset side. And I think in our view, that's how you will ultimately reconcile the illiquidity premium of assets that offer additional risk or additional premiums due to liquidity or discoverability or what have you. Because also the even the TikTok loans will have some amount of duration in terms of revenue collection, like the time between a view and an advertising payout, even if it's the space of a few days, still creates some duration from the perspective of a DeFi user. I think understanding the asset liability management and looking at things more like a stablecoin is kind of the model that we're going to be taking that we take already for the sort of V1 vaults, and that will migrate into the V2 world. But yeah, personally, it will be fascinating to see the option space of loan opportunities that will become available and how different curators are going to start underwriting them, and who is going to be ultimately the originator of these YouTube loans, SME loans, what have you. In the future, like it would be nice if YouTube, say, paid in stablecoins, so that you minimize the frictions and start to actually originate loans on chain, right? So that an SME that finances a receivable receives stablecoins and uses those stablecoins to run their working capital. Like this is kind of the ideal end state that we'd like to land in.
Yeah, I mean, I don't want to derail us too much and talk about YouTube and TikTok loans too far. And I know we got to wind down here in a second, but yeah, one other, and Monet, maybe we can talk about this bit in the wrap up, but it's actually an old business model, is of subsidizing the product with a financing division. So like I'm thinking about cars actually, or something like that. Like most of the time those are sold almost at cost. And the way that you actually make money is by financing the car. That financing division is owned by a dealer or something like that. And, if you take what Morpho and risk curation is to its extreme, right? You can see, I mean, you don't have to squint that hard at it to actually see something relatively similar there. Like, and that actually brings me to at least where I would love to end here is like, I kind of see there are originators right? There's originators, there is our curators, and there's like the protocols themselves, like the Morphos of the world. And maybe Monet, I can actually start with you with this question, but how do you guys see the evolution of the risk curation model? Is it at this is the question everyone loves to ask in crypto. Is it at the commoditized part of the stack? I think that the flagship vaults, at least for Steakhouse and Gauntlet on Morpho, I don't think there are any fees being charged on the USDC vault. So, I'm curious, do you view it ultimately as a commoditized space? Does the value lie with the originator of the protocol? Is there a way that we can monetize on the risk curator side of things that isn't super obvious yet? How do we see that value accrual component?
Well, I'll keep my bit just really short and sweet here, but I think you see a lot of curators not monetizing much now, running very low or sometimes even zero fees because they think that there's long-term value in acquiring deposits, sort of gaining brand value, and then also just acquiring users. Um, so yeah, I think that's in a way like whoever can get closest to the user and own like some sort of user relationship, whether that's with your depositors or maybe with your borrowers. Um, that's sort of like where the intangible value of this curation business sits. So maybe protocols will have that, maybe curators. I think there's actually a good argument that curators are going to sit closest to the user and end up capturing a lot of the value from this.
I would tend to agree. Like the relationship with the user is ultimately where most of the value and brand is accrued. I don't think it necessarily means that the curator won't ever get commoditized or like or that the protocol will eventually get commoditized. There's always going to be an element of differentiation possible, right? There's never going to be one single oligopoly of like, just like today, you don't have one bank doing everything. There's always going to be an element of brand. There's always going to be an element of differentiation. There's always going to be the ability to sequence risk and capture new segments of users. And you'll have curators that cater to those. And arguably, in traditional finance, you have that distinction as well, where if you abstract away the regulatory aspect of it, the investor in a fund or in a debt fund, for example, is one particular type of user segment, and they may have a bank account as well. They may concentrate most of their wealth in fund management, whereas a retail bank deposit user, even if they ultimately end up doing very similar things on the asset side, rely on the bank for different reasons, and they may not even necessarily be related to the size of the capital. So I don't think it's necessary. The one advantage in traditional finance is that a lot of the interoperability is abstracted. So when someone makes or issues a loan, to a degree, when somebody takes out a loan or mortgages a house or whatever, they don't necessarily care who the originator is or what rails it's on or what, bank deposit stablecoin type they receive. Ultimately, they just care about getting the best rates and financing their home. In DeFi, one interesting thing is going to be to see how fixed rate loans interact between each other, because like I said earlier, in the same way that we don't have singleness of money among stablecoins, even if you had a Bitcoin fixed rate loan on Morpho and a Bitcoin fixed rate loan on something else, they're not immediately transferable, and so there's immediately a secondary market need to sort of arbitrage the price, and I think that'll ultimately keep it always exciting. Curious to hear what Tarun thinks.
Tarun, close us out here.
Yeah, I actually think, and maybe this is the bias from my background, but like I kind of think of the institutions that I view as being the kind of correct view of Curator, in my opinion, is like more kind of like multi-strategy hedge funds than like a bank in some ways. Where, if I look at the history of multi-strategy hedge funds over the last 30 years, a lot of them have had lifetimes much longer than banks. They haven't had to do M&A. They haven't had to get kind of their banking regulator slapping them on the risk. A lot of them just shed some pods, gain some pods, and they're able to kind of grow. But the way they think about risk management is very different in that they generally think about like, what is the overall portfolio Sharpe? how concentrated am I in any strategy? How do I think about allocation across all the strategies? And how do I kind of ensure that, hey, when I get withdrawal requests, that, like that's my demand deposit type of thing where my LPs start trying to redeem, that I can exit. And like some of these strategies are sufficiently liquid. Some of these strategies maybe are not liquid. So I have to like borrow against them and I have financing costs. Like all of this type of stuff, I feel like to me is more like curators. And that's why I actually view the curation model as more about aggregation than about like a single model. We spent a lot of time talking about lending today, but I think as the set of products on chain grows, whether it's the perpetuals products, whether it's like, hey, maybe one day RWA like stock type things actually get traded a lot. I'm not gonna say that I believe that or don't. I'm just like, hey, if that market exists, they're obviously gonna need lending. And a lot of the staking market, I think you kind of want to take the bet that in aggregate, you will be able to find relatively good risk-adjusted yield at like a sufficiently high Sharpe that is your model versus trying to like, I think bet on a single thing. And I think lending curation is the bedrock of everything else. In the same way that like, if you're a multi-strategy hedge fund, your structural advantage oftentimes versus a competitor is what ways you have to borrow and ways you have to get financing to open new strategies or open new trades, right? And that cost of capital. And in general, I think like you have to be, in the case of on-chain lending, like you have to be close to that to get that, right? It's like a little different than I went to play golf with a banker or whatever, like however or like, oh, we just happen to have a big enough balance sheet that like this bank is desperate to lend to us. It's a very different thing. You actually really do have to be much more in the weeds and understand that. And so, yeah, I just view the aggregation effect of curation as kind of the important piece. And I think it's a little bit like wholesalers and marketplaces who aggregate demand and supply and help match them. And oftentimes they're not necessarily bigger than any single marketplace, but they can oftentimes, if they aggregate across marketplaces, be a large sustainable business. So I guess I take the view of like the institutions that have Millennium has lasted longer than like every bank I see in the U.S. other than like Chase, right? All the other ones have had crazy M&A. They've had to divest stuff. They've had huge fines. Like I think to me those are like better institutions at kind of these kind of credit capital management. But that's the way we view it, is like lending is always the core, but as this ecosystem grows, as stablecoins grow, like inevitably there's going to be tons of different types of opportunities that will be curated.
And not to belabor the balance sheet point, but it ultimately all does come down to what the funding cost is to raise the balance sheets and how effectively a curator can manage those assets on chain to generate the necessary return on assets to be profitable and to pay that funding cost. And that kind of the world of on-chain asset management has very strong elements of what Tarun was describing. I agree, of like aggregation and flexibility also in terms of, at the moment, it's easy to say flexibility just because from the infrastructure perspective, it's easy to write smart contracts and everything is kind of interoperable. Today, at least in DeFi, everything is still kind of circular to a degree. But the really interesting components will emerge when, these curation businesses really do start looking more like on-chain asset management with elements of immutability and all of the things that make crypto an actual value proposition.
All right, guys. This was a really fun one. Thank you both so much for coming on here. Adrian, Tarun, if folks want to find out more about what you're doing at Steakhouse, Gauntlet, just get more information, what's the best way to do that?
Twitter, the website, and of course the vaults.
I think Twitter, websites, Onchain.
Beautiful. All right, guys. This was a ton of fun. Thank you so much for coming on.
See ya.
Cool. Thanks.
Yeah.
All right. Good up. That was really fun to get Adrian and Tarun. On the same competitors, in a sense. I guess all three of you are somewhat competitive.
Yeah.
I guess.
Yeah, it's like a cooperation, I guess. Like I think we're all good friends and have mutual respect, but they're in a lot of respects probably our two biggest two of our biggest competitors, a few others as well.
Yeah.
But yeah, great to have them on.
It was a lot of fun. Maybe we could start at the end there around where you see, like, how competitive you see curation getting, and just sort of, do you see it as a commoditized business? And I think your opinion is that it is relatively commoditized, if I had to maybe put words in your mouth or reiterate what I heard you say at the end of that episode there. And, within that context, then I would love to understand how you think about brand within the, because for any product that's commoditized, the one lever that you have for the most part, outside of some sort of specialized distribution, is brand. And yeah, we didn't really talk about that so much, but it would have been interesting to get Adrian's take on this, because I know Steakhouse has different names for some of their vaults. There's the Steakhouse USDC, and then they have Smokehouse for some of the higher yielding stuff. So yeah, talk to me about how you kind of think about the brand lever here in the light of curation.
Yeah, no, I think you clocked correctly sort of my views. Like the actual curation part of being a vault curator, where you're identifying strategies or pools that you want to lend to, or like sort of identifying like the risk reward of stuff. I don't think there's much of like long-term like moat or defensibility there, because you're executing all these strategies on chain. So there's nothing to prevent someone from just doing like a trend following strategy, coming in after you and undercutting you on lower fees. And I actually think, so far on Morpho V1, we've seen a lot of that, where someone will develop a interesting, like a new pool, like lend against Pendle or something like that, and immediately, everyone else is kind of just following them in and compressing the margins there. So the actual curation part of being a curator, I don't think is particularly defensible. But when you look at, let's take Gauntlet for example. They actually, I would say they're pretty well known. It's a very strong brand. I think Steakhouse as well. And people, I see people go to Morpho to invest their capital, but I almost think in a way like they're trusting in Gauntlet or Steakhouse or, BA. I think we're a bit less well known, but we're getting there. They're kind of trusting in the curator more than the protocol. They know the protocol is like this base layer, and actually the differentiation of like, who's taking what risk and who you're operationally like depending on to do a good job is the curator. So I think the brand value is a pretty big factor there. And I think there is a huge like BD and distribution aspect to it. Like, you see these, tens of millions of dollars deposited into someone's vault. Generally, it's not just some whale who like showed up on the Morpho front end and said, "Oh, that looks good." Like, there's a whole sales cycle to close for these really big users. So there's a lot of interesting stuff, happening kind of below the surface with this.
Yeah, okay, so I'm gonna maybe push an analogy here and stretch it, but I want to get your take on whether or not you think it makes sense. But okay, if you were to look at, because you mentioned at the end of at the end there, maybe it was Adrian, that yeah, it doesn't really matter, who gives you your mortgage, is just the best rate. But you still do need, you wouldn't go to some random shopkeeper on your street and get a mortgage. You're going to like Wells Fargo or Bank of America or someone like that. So brand and trust do matter a lot within finance. And I think there are strong, I don't know if they're network effects, but they're definitely a moat. And when I look at, okay, let's say that the architecture of protocols like Morpho drastically decrease either funding costs by making depositors, like anyone can just deposit globally, or it's shared backend. So, you take some costs out of a bank or something like that, but you still do need that. Where do I go to get this, right? Like, where do I go to get a loan or whatever it is? So weirdly, I could see the curators, if they continue to scale, right? Like, this is a very weird far out future, but it could be lenders with a big brand, even a big bank, even a bank that is kind of built on top of Morpho. Like, I'm curious, maybe reframing it from that standpoint, if you saw like a curator, offer different types of financial products built on top of Morpho like rails, maybe brand actually does become a moat and you can create a really big business here, and then you can become an originator, right? Yourself. But
Yeah, I think there's, like there's not too many different curation opportunities right now, but there's also like a kind of interesting opportunity for like cross-selling, I think, when you have a developed brand as a curator, and then you're also offering products across different opportunities. So like,
Mhm.
Steakhouse, they have like some Morpho vaults, um, but they also work on restaking products. You can go
Yeah,
stake with Symbiotic or something like this, and it's curated by Steakhouse. So maybe if I've had a good experience with working with them on Morpho, then I'll be happy to, as I'm looking for restaking, I see, oh, Steakhouse. I recognize them. I'll put my money in with them.
yeah,
So I think, uh, maybe if it's just Morpho, it's like it's a little bit tougher. But as the whole space gets like kind of more fragmented with just more opportunities, it's possible that curators will be kind of like the focal point for people having brand recognition for these different products.
Mm. Okay, I want to end maybe with talking about. I feel like we talked a little bit about V2 and what fixed rate borrow lend does on the curator side of things, but I would also love to get a sense of how BD is now being split in between, the protocol itself, like Morpho, who I know has an active BD team, but also the curators do some amount of that as well, is my understanding. And so, yeah, I kind of want to, maybe putting back your BA Labs cap on here is a lot of that outbound going to, I don't know, the fintechs like the Coinbases of the world to be like, hey, deposit, use our vault right on your back end, or is that still mostly Morpho? And how do you see the balance evolving over time?
Yeah, I'd say it's a bit of a mix. Like I think Morpho is in a lot of these curation protocols, like uh, the protocols, they understand that they need their curators to like have some wins to like bootstrap a ecosystem of curators and make the whole protocol system work. So I think Morpho and like some of these other protocols that are offering curation, they do try and open doors. Um, it's challenging because they also want to be neutral between all of their, they want to love all of their curators equally. So, I think you'll see cases where they'll just try and like put you in touch with someone who's come in as like an inbound for them, or that they've developed a relationship. But then it's really just kind of, it's a warm handoff, and it's up to you of how far you can run with this discussion, whether you're going to be the curator that someone chooses to work with. Um, so yeah, I would say it's definitely a mix. I expect that Morpho is going to probably do less and less of this, or the protocols are going to do less of that over time. It'll be um, more on the part of the curator, because the curator kind of has more economic direct upside and like sort of incentive alignment um, for landing these deals. They're the ones who are taking the performance fees when they get more AUM.
Mm,
They're the ones who have to have the difficult conversation when they, take a haircut on the vault, and all these clients they brought in lost a little bit of money, um, which hasn't really happened very much yet, but it's bound to happen at some point. So I expect it'll be a lot more curator driven,
mm,
and the infrastructure will be kind of neutral.
mm. And do you expect on what time? I know we were talking about very futuristic stuff here, like TikTok or YouTube or car dealerships or whatever. But okay, here's an earlier iteration which is happening now: is you have Spark as a curator on Morpho, right? That's kind of that's kind of a an instance of a corporate, not necessarily an active like a curator, but someone who's a protocol and a lender themselves actually leveraging one of these vaults. So that you can maybe look into the future. And if you were to say, okay, this ends with, banks or very differentiated types of originators, leveraging Morpho, maybe Spark is kind of the first iteration of that makes sense. So yeah, I'm curious, if I had to poke at you and make you guess, like, what does the evolution of this market look like? Is it more, BA Labs or Steakhouse type competitors, or do you start to see maybe protocols within crypto kind of leverage, the unique infrastructure here to create their own vaults, or even, corporates outside of crypto?
Yeah, I mean, so like Spark is maybe the biggest example of like a protocol or sort of quasi, it's like an on-chain company. You could look at it that way,
Mm,
who is run strategies on Morpho. They have the biggest vaults currently on both mainnet and base. And BA, we like in a way we're kind of like below the surface doing curation activities because we're like the sort of risk partner for Spark. Um, but there's been other examples as well. So on base, there's a few other protocols. There's Moonwell, who we work with. There's Seamless, who is another lending protocol that I think Gauntlet
right.
is kind of like doing this white label product for. There's Gauntlet's had this Compound Blue partnership where, Compound is kind of like white labeling a brand onto Morpho Vaults on Polygon.
Mm,
Um, so it's, I think it's a popular um, it's a popular trend. You do see that more and more. And I guess maybe like what I sort of drill that down to is like um kind of almost tying back into what Adrian was saying is like we're making balance sheets and the balance sheet starts with sourcing, kind of the best possible cost base you can have on the liability side, getting deposits. Um, and I think protocols are very well suited to that because for some of these protocols, they can run incentives. So like Compound, Moonwell, they're running like incentives to get in deposits, which as an individual uh, curator, Steakhouse alone going in, they can't offer that because they don't have a token. Um, or with the case of Spark, they kind of have this locked in, extremely favorable cost base from Sky, which is kind of like this happy accident of history where there's just a lot of people who forgot their money in DAI, basically. Um, so yeah, I think it's in a way that's kind of the edge is like how can you get the best possible lowest cost of capital and commercial banks they have extremely cheap. They have like all these people earning nothing in checking accounts. So I think that's a super favorable source of funding. People like PayPal, who like when your money's sitting in your PayPal account, I'm pretty sure you're not earning anything, or Venmo, or these fintechs. So um, I think yeah, if you could partner with them, or if maybe these people just start coming and operating vaults themselves, they kind of have a huge edge.
You know, I feel like, sort of a side tangent here is I feel like stable coins are leading me to a line of thinking that checking accounts are a scam, actually, in a sense. Like there are products that already exist in crypto where you can just keep your USDC in a Morpho vault earning yield up until the exact moment that you want to spend it, which is, the banking equivalent would be by default whenever you deposit into a bank, you just put your money in a money market fund, you earn yield, and then whenever you want to spend it, it gets converted. That's what it should be. It's kind of crazy that banks just have the structural advantage of this really low funding for deposits, and it feels like crypto should fix this.
Yeah, I mean, I think it's like it didn't start as a scam, but it's like a model that has outlived its usefulness, where there needed to be some way to kind of subsidize the cost of banks managing all these paper checks and having,
Right.
wheelbarrows of cash that they're sort of taking around the country and rebalancing all the place. Now, like, the actual sort of nitty-gritty of processing a payment with crypto rails is like minuscule small, and it's small enough that the end user is basically able to just manage it with gas fees. They don't need to have some sort of cross subsidy thing happening. So yeah, it's like it's interesting to see that that's just like sort of an artifact of history where it made sense maybe 20 plus years ago, but um, it doesn't make sense anymore. And we're just slowly waking everyone up like, hey, you have money at Wells Fargo earning 0.01%. Wake up.
Yeah, totally. I mean, actually, someone was pointing out to me, I can't remember who, that even this is different in between the US banking system versus other banks in Europe, I guess, are much better at giving yield. But also, I guess there was a difference post 2008, the great financial crisis. It was much more of the norm that the yield in your checking account would track Fed funds, but now that's just changed for whatever reason. Okay, last question for you here, Mona. I would love to get your thoughts a little bit if I could ask you to wax poetic on, what do you think that Morpho V2, fixed rate borrow lend, what does that do to the role of the curator? We got into it a little bit with Adrian and Tarun, but yeah, I would love to get your expanded thoughts on how you see that evolving, different types of strategies that you might be thinking through. Give us some of that inside baseball special sauce here. But yeah, I'd love to get your thoughts.
Yeah, I think it's going to get a lot more challenging to be a curator. As it stands now, you have to identify kind of what pools you feel safely about and have some sort of like light infrastructure to be rebalancing between the pools that you whitelist to, kind of optimize the risk reward, not be over concentrated. But it's in a sense, it's fairly simple. When you look at V2, where you're, basically bidding on these fixed rate loans, you have to manage not only, what sort of collaterals and LTVs that you're comfortable with, as an example, which is same as V1, but
Right.
you also need to be thinking about how much duration you want to take. So like, you have to like sort of have an active view of how many of your users are going to want their money back in the next month, 2 months, 3 months. You have to have an active view on where you think rates are going, because if you take a fixed rate loan for 3 months now at, let's say, 6%, which is more than you can get on Aave or variable rate lending right now, but then suddenly next month we're in a bull market, you're giving up a lot of profit that if you had just kept it in variable, you'd actually have done better. So you just have to take a much more active view on markets. And I think the execution also is more challenging, because you're not just like adding or subtracting funds from a pool where everyone is kind of getting paid at the same rate. So it doesn't really matter very much if you're first or you're a little bit later to get into the pool or get out, except for rare cases where a pool is like potentially going to default. But there's going to be all of this kind of PvP aspect of like, if you can get your offer into the order book one tick higher than everyone else, then you get all of the deals and the other person gets nothing. It looks more like being a bond dealer, which is it's a complicated and more challenging enterprise, I'd say, than how curation looks in V1. So I think just everyone's gonna have to tool up. It's gonna be a whole new ballgame.
It's the big leagues, baby.
Yeah.
All right. Monet, this is a fun one, my man. I will I'm sure I'll see you in person this week for permissionless. And
Yeah.
man, it'll be a blast. And I don't know. Jason and I said that depending on how many tickets Zero X Research sold, we might do the dunk tank. So I think we might be getting dunked this week, actually. So we'll see.
Well, I'll be there.
Yeah.
I'm not very good at pitching though, so you're in luck.
Pray for me. All right, partner. I'll see you next week.
Yep. See ya.